Hello and welcome back, guys. So, in this session, we will be doing question number 6, which is about Ashanti. Okay, I think it's question number 5 or 6. Let's see. The number is not there. It's 6 from SPR's exam kit. Okay, so what we are given is that the following financial statements extracts relate to Ashanti, a public limited company, and its investment, right? So what we are given is that we've been given the revenue, cost of sales, gross profit is also given, okay? So what we are required to find out is that, so explain with suitable calculations how Ashanti should deal with the sale of equity interest in Bochem in the consolidated financial statement, right? So it's about that, and the second part being about equity accounting method, right? So we will look at that as well, which is about serum, right? And then additional transaction is Asante sold inventory to both Bosam and Serum in October 20x8. The sales price of the inventory was 10 million and 5 million respectively. Okay, Asante sells goods at a margin of 20% to group companies. Okay, at the year end, half of the inventory sold to Bacham was unsold. The entire inventory sold had been sold to third party. Okay, at the year end, Asante sold goods on credit to Spice, a unrelated company, and recognized revenue of 5 million. Before the date of the sale, the customer had made an arrangement that it would be restructuring its debts. At the date of sale, it deemed improbable that Asante will recover the amount outstanding. Okay, so explain with suitable value the sale of this thing, right? Wocham, right? Okay, on 1st May 20x7, Ashanti acquired 70% of equity shares in Bocham. So 1st May, when is 1st May? So this is 30 April 20x9, right? So how many years ago? 1 year, 2 years ago. 2 years ago it acquired, right? Now May 0x7 to 20x8 May, right? And then after that from 20x8 May to 20x9 30th April. Okay, 2 years. Santi acquired 70% of equity interest in Bochum. A public net assets was 160 million. The share capital return earning were this, and OCE was other component of equity was 10 million at the date of acquisition. The excess of the fair value of the net identifiable assets is due to increase in the PPE, which is depreciated on a straight line basis, has a 5 years remaining lifetime. At the date of acquisition, depreciation is charged to cost of sales. Santi disposed of 10% equity interest in the non-controlling interest of Bochum on 30th April 20x9 for a cash consideration of 34 million. The carrying amount of the net assets of Bochum at 30th April 20x9 was this. The goodwill arising on acquisition of Bochum was 44, had a reduced value of 20, right? Okay, so let's do it in our spreadsheet first of all. Working with one group structure. Sure. Before sale, parent, NCI. So before sale it was, how much was the 70 and 30, and then 10% equity interest sold, right? So that means 7, so it'll be in percentage. 70 and then 30. After sale parent NCI will be 60 and 40, and then working note calculation of net assets of subsidiary, right? At acquisition, disposal, bold share capital, retained earning, other component of equity, fair value adjustment, plant, excess depreciation, okay, so let's find out the figures. So 160, right? 160, 55 and 85. 160, 55 and 85. And then 10, right? So this will be this minus this minus this minus this. So 10 is the fair value adjustment, okay? That will be same. So what's our net assets at disposal date? So when did we dispose it off? So dispose 10% on 30th April 20x9. So at the year end itself, right? So it disposed off at year end, okay? 210. Okay, 210. 210. That's given, and then let's see the timeline. Let's say timeline first of all. So when did we acquire it? 1st May 20x7. So that means 30 April 20x7. And then 30 April 0x8. And then 30 x9, right? Yep, it's 2 years. So our excess depreciation will be this divided by what's its life. Its life is 5 years. Divide by 5 into 2 minus 2. Right, before any adjustment. And then goodwill, let's see goodwill. 44 reduced by 20%. Working note 3. Calculation goodwill. Calculation of goodwill. We know goodwill already. 40, I guess. 44. Impairment. Goodwill at disposal. Into 0.2. Right, so this is how goodwill at disposal. And then let's find out what has happened during the thingy. So since control is not lost, so control sale, right? So in this case, what has happened is that proceeds over, what we do is that we debit cash, then after that credit NCI, non-controlling interest, and then after that credit or debit that, right? So how much did we get the cash? So cash consideration 34 million. 34. 34, right? And then NCI, how much did we give them? Is this figure plus this figure into this figure, right? Into 0.1, 10%, right? So that's our cash, and then so this minus this is how much we give them. Credit other component of equity. Okay. What should we give them? So what's our net assets? What's our net assets? The carrying amount of net before any adjustment. Okay, so these three are 210. Okay, so these three are 210. That means is equals to sum. Okay, now it's good. All right. Okay, so let's explain it. Sale of shares in Bochem, right? So what has basically happened is that in this case, the sale does not result in the sale of Bochem by Ashanti does not result in control being lost. So it is treated as transaction between shareholder and no gain or loss is recorded in financial in consolidated statements. Statements, right? It is simply treated as an increase in non-controlling interest. From 30% to 40%. The non-controlling interest (NCI) is increased by this figure 25.1 $25.1 million. All right, and then after that, and other component of equity will increase by dollar 8.9 million. And then what I will do over here is, let's see, So I won't quote it over here directly, okay? So it's in spreadsheet, okay? So now what are we required next is, so how should we deal with sale is already done in consolidated financial statement, 6 marks. Okay, that's done. And then explain with suitable calculations how Ashanti should deal with the sale of equity interest in Serum and its remaining investment in Serum in consolidated financial statements. How much did it sell? Ashanti acquired 80% of equity shares on May 1st, 20x7. That means on same date. Yep, it's on same date. That means 2 years has gone by. Purchase consideration was 95.2. Net identifiable assets was 115. NCI of Serum attributed to Ashanti had a fair value of at that date. Okay, at this date. So 20% was 26 million. Okay, on 1st November 20x8 disposed of 40%. So on November, that means after. So that means when will that be? So I'll just write sale of Serum. Let's look at our timeline. So when did it sell? Says that it's sold on 1st November 20x8. 1st November 20x8. X8, right. So before sale it was 80 and 20, right? 80, 20. I mean 80 and 20. The sale it is, so 50% was sold, right? That means only 30% is remaining. 80, 30, 80, 50, yeah. 50, that means it won't be a subsidiary after that. But still, what level is that? So this will be reduced to 30. Okay, so what about our total assets? Our net assets at acquisition date is 115, right? 15. So let's calculate this time period. So it happened during 20x8, right? Uh, let's remove all these values from here. At disposal date, the net assets was, how much was its net assets was 160 million, right? 160. Okay, so let's calculate few other things. So how much time it's left after it has sold it? So it's sold on 1st November. That means November, December, January, February, March, April. So 6 months. 6 divided by 12, right? Okay, good. So let's calculate the gain or loss on disposal. Hold disposal proceeds, fair value of retained interest of retained interest, and then fair value of retained interest, right? So how much is it? Disposal proceeds 90 million. 90, right? Fair value of retained interest is, how much is the retained interest? 45. And that means this plus this, less interest disposed of. NPE REST disposed of. So uh, goodwill at disposal, net assets at disposal, less NCI at disposal. Okay, pretty easy as well because we've already been given everything. So goodwill at disposal is, where was the goodwill, man? Fair value was this. Dot, dot, dot. No, goodwill is not there. So we need to calculate it. Let's calculate it. That's easy. All we need to do is that related cost, fair value of NCI, less net assets at acquisition. Alright, total goodwill. Goodwill at disposal date will be same over here. There is no purchase was 95.2, right? 95.2. Fair value of NCI at this date was 26,115. 26,115. So this value plus this is that, and then minus net assets. This will give us the goodwill, right? So goodwill is 6.2, no impairment, right? Let's check that one more time. Had been impairment tested, no impairment has occurred. Good. So it will be this figure. For that, net assets at disposal is 160, and fair value of NCI was 35, right? 160 and 35 minus 35. So sum of all this thing. So this should give us the profit or profit on disposal. Profit on disposal. Okay, it's pretty simple. All right. So the sale happened during this period, right? So total profit for the year was 14 million, right? 6 divided by 12. So profit on disposal plus profit for the year, right? Santi should prepare consolidated financial statement for the 6 months and when and after 1st November 20x7 will cease to consolidate in SOPL and SOFP and will recognize profit of 3.8 on disposal. On disposal in consolidated PL, right? And then after that, investment in associate, right? Mm, remaining interest. The remaining 30% interest will be equity accounted as per IAS 28. All right, and then after that, how much profit will they recognize? So 14 million into 30 into 6 divided by 12, 14 into 0.3 into 1 by 2, 6 divided by 2, 12, 2.1. We could 4, then after that, share of profit from associate dollar. How much million? 2.1. 2.1 million will be recognized in consolidated statement of profit or loss. Anything else? In SOPL, okay, it's not talking about that. SOP, it's not talking about that. Right? So, sorry. Once that's done, so 2 is also done. So this is not B. Control Z. Okay, and then so third question is, taking into account of all the information presented, calculate the revenue and cost of sales figures that would appear in consolidated SPL. Your answer should include an explanation of correct treatment of Ashanti's sell to spice. Okay, so what we need to do is that calculate. Okay, so we need to give some explanation as well, right? Okay, so let's do it. First of all, let's see what has happened with this. Okay, so Ashanti has sold to Bochum, right? So PURP, working note 5, PURP Bochum, right? Bold it, and then what has happened with PURP? October 20 exit, right? So when did the sale take place? So in case of this, it took at the year end. So in case of that, it took earlier. Okay, so cost, selling price, total goods, remaining goods, right? Same thing for other fellow as well. URP serum. So how much did they sell the goods for? 10 million to Bochum, 5 million to Thingy. 10, 5, profit margin being 20%, right? Let's do it this way. Let's do it differently. What we'll do is that let's prepare revenue first of all. Revenue. Okay. So suppose this is consolidated financial statement, right? So PL. All right. So in revenue, what we are given is 810 to 35 142, right? 810 810, right? 810 to 35, and then what else we are given is 142, right? So Bochem and then serum. So serum is 142, right? 142 into 6 divided by 12. Okay, so we only consolidate for that many period, right? And then after that what we do is intra-group transaction, right? So how much has been the total intra-group transaction? Intergroup transaction is this figure, right? Is Bochem and then intergroup zero, right? This is this figure, right? Figure. Okay, so this should be in minus. Okay, minus this figure, then this should be in minus this figure, right? And then after that, what else do we have as a sales? As a sales, at the year end, Ashanti sold goods on credit to Spice, an unrelated company, and recognized revenue of 5 million. Before the date of the sale, the customer had made an announcement that it would be restructuring debts. At the date of the sale, it is deemed improbable that Ashanti would recover the amounts outstanding. So that means the revenue that has been recognized, right? That should be changed back again. So 5 minus 5 again. Spice sale, right? So this will give us our sum. This is our revenue, right? So cost of sales. Cost of sales will be, so what's for Ashanti, Mocham and Serum is, first thing first, let's write it down. So 686, 137, 84, right? 686 137 and then 84, right, into 6 divided by 12. So what do we have is excess depreciation. So cost of sales will be depreciation as well, which is this figure. Remember, we had, how much was it? It was, excess was 10 divided by 5 into 2, right? 4 was that. And then after that, what else do we need to reduce? Intergroup transaction. Group Bochum serum, right? So this is 10, this is 5, and then after that, what's the unrealized profit on this? So how much did they actually sell? So Ashanti sold, I mean, what is it? Half of the inventory sold to Basam remain unsold, right? But the half entry sold to Seram. But the entire inventory sold to Seram is already sold. That means remaining goods is 0. So PURP is 0. PURP is 0. In this case, PURP half is remaining, right? So this divide by 2. This is actually this figure into 0.8. So this will be same figure, and then our PURP is 5 minus 4, 1 million, right? So we will need to reduce that figure as well. So PURP, or I mean it will be added to cost of sales, right? We made a mistake over here. So this should be minus 10 because it's intergroup transaction. So we need to reduce it from cost of sales, from revenue as well, right? Whereas PURP we added up. This is only for 1 year because we are only preparing consolidated financial statement for 1 year. Okay. Anything else? So what I'll do is I'll just give a short explanation on this thing. Okay. Calculate the revenue, your correct treatment of sales to spice, right? Will that sale be recognized or not? Why we won't recognize it? Because as per IFRS 15, revenue from contracts with customer is used. So it can only be a 5-step model is used, right? Used. Firstly, when identifying the contract, following things should be determined. And then what are they? Following things that needs to be determined are, first thing first, the parties involved, the rights and obligations can be identified, and then after that, the contract has commercial substance, payment terms can be identified, and then it is seller is guaranteed the consideration or it is probable the seller will collect consideration which they are entitled to. Okay, and then after that, in this case, contract does not meet the last criteria, as they cannot collect consideration as Ashanti. It is entitled to, so no revenue is recognized since revenue has been recognized. Must be reversed. So how is it reversed? Debit revenue, credit receivables. How much was the sale? I guess 5 million. 5 million, yep. For 5 million, right? Okay, so that's done too. Okay. So this will do this much for this part, and then we'll look at control after this. Okay. So let's define when there will be control, when they have power over the industry and all, when which I've been discussing about it a lot. So we'll look at that. Okay.